Imagine $1 trillion just changing hands in a matter of 6 months.
It's almost hard to wrap your head around.
It really is. I mean, that is the entire gross domestic product of a medium-sized country just moving across the globe right under our noses. It's this staggering amount of capital, and it honestly completely alters the gravity of the global economy.
Yeah, it absolutely does.
Yeah.
Because when you are looking at capital flows of that sheer magnitude, you aren't just, observing isolated business transactions anymore. You are watching the tectonic plates of the global market shifting in real time.
Right, and that is exactly our mission for this deep dive. Today, we are looking directly at the prepared remarks from the Q2 2026 earnings call for Goldman Sachs. And this is straight from the top brass, so the CEO and the CFO.
Indicators.
Exactly. So if you are listening to this right now, whether you are managing your own portfolio or maybe running a company or just, trying to understand where the world's money is actually flowing, consider this your cheat sheet to the future.
I like that, a cheat sheet.
Because we aren't just reading a bank's quarterly report card here, we are unpacking the financial blueprint for these massive structural shifts that are happening right now. We're talking everything from commercial space exploration to the physical infrastructure powering artificial intelligence.
Yeah, and the numbers they just released for the first half of 2026, they really provide this kind of diagnostic x-ray of those shifts. They reveal not just how much money is moving, but more importantly, the underlying mechanisms driving those moves.
Okay, let's unpack this because we really have to start with the sheer scale of these Q2 results just to establish a baseline.
Well, for sure, the numbers are wild.
They really are. We are looking at record Q2 net revenues of $20.3 billion and record earnings per share of 20.98 cents. And they also reported a return on equity, or ROE, of 23.5%. And I know ROE is like a classic finance metric, but in the context of a massive, heavily regulated bank in 2026, how should we actually be reading that 23.5% figure?
Well, think of return on equity as essentially a measure of efficiency. It's how effectively the firm is using its shareholders' capital to generate profit.
Right.
And hitting 23.5% is just exceptionally high for a globally systemically important bank. It basically means for every dollar of equity sitting on their balance sheet, they generated roughly 23.5 cents of profit over the year.
Wow.
Yeah. And in a regulatory environment that forces banks to hold these massive, massive amounts of capital in reserve, achieving that kind of return indicates they are just firing on all cylinders across their most lucrative divisions.
And that leads directly to the statistic that absolutely stopped me in my tracks. Large cap corporate M&A, so mergers and acquisitions, is up 90% through the first half of 2026.
It's just a massive jump.
Right. Goldman Sachs advised on $1.2 trillion in announced deal volumes. They crossed the $1 trillion mark in just a 6-month window, making them the first bank in history to ever do so. And they're leading their closest peer by like $425 billion.
It's an incredible gap.
It is, and we're talking about really marquee mandates here. They were the lead left bookrunner for that record-breaking SpaceX IPO. They handled a massive equity raise for Alphabet, and they advised on Dominion Energy's sale to NextEra Energy, as well as Comcast's spinoff of NBC Universal.
The diversity of those deals is honestly just as important as the dollar amount. I mean, from aerospace to utility grids to media conglomerates.
I do want to pause on one of those terms, though, before we go too far. They emphasize being the lead left bookrunner for the SpaceX IPO. What is the actual mechanism there? I mean, why does lead left matter so much on an earnings call?
So the terminology actually comes from how the physical prospectus document is printed. The bank listed on the top left of the cover is the one running the show.
Oh, literally on the left side of the page?
Exactly. They aren't participating in the IPO, they are the conductor of the orchestra. They determine the pricing of the stock, they allocate the shares to institutional investors, and, crucially, they take the largest percentage of the underwriting fee.
Okay, that makes sense.
Yeah, it is the ultimate status symbol in investment banking. It signals that a company trusts you above all others to kind of navigate their public debut.
I see. So it's like the prime real estate of Wall Street bragging rights. But I have to push back a bit on this overall M&A explosion. How is there possibly this much appetite for mega deals right now?
That's a fair question.
Because with $1.2 trillion in deals, I just have to ask, is this just a bubble of corporate shopping? It really feels like executives are just buying competitors because they have the cash lying around.
Well, it definitely looks that way on the surface, but the management team actually attributes this to a scale imperative.
A scale imperative.
Right. This is not some ego-driven shopping spree. It is literally a survival mechanism. The global business landscape is evolving so rapidly and honestly becoming so incredibly expensive to operate within
Hmm.
that clients are pursuing greater scale just to maintain their current market position.
Wait, really? So you literally have to buy a competitor just to afford to stay in the game?
Precisely. I mean, think about it. If a corporation wants to overhaul its global supply chain for resilience, or if it needs to invest billions in proprietary technology just to remain relevant, a mid-sized balance sheet just won't cut it anymore.
So they have to bulk up.
Exactly. Companies are merging to pool resources, to reduce overlapping operational costs, and basically build this fortress balance sheet capable of absorbing massive R&D expenses. The fundamental cost of competing has just increased.
Which naturally forces us to ask what exactly they're spending all that pooled money on. And the earnings call transitions very clearly from the sheer volume of these deals to the primary catalyst driving them, which is the AI investment cycle.
Yeah, the CEO's remarks really highlight that we have decisively moved past the theoretical phase of artificial intelligence. The
Yeah.
capital needs are expanding rapidly outward from, core Silicon Valley technology.
Here's where it gets really interesting because they note this AI cycle is generating a massive ripple effect into physical infrastructure, energy, and data centers.
It's touching everything.
Yeah, it's like the gold rush, but instead of just selling pickaxes to the prospectors, they are out there financing the transcontinental railroads, they're building the saloons, and they are laying the heavy telegraph lines to support the entire town.
What's fascinating here is how that ripple effect alters completely unrelated industries. Like take that Dominion Energy and Extra Energy deal you mentioned earlier.
Right.
On paper, that is a traditional utility sector transaction.
Yeah.
But beneath the surface, it is completely an AI story.
Really? How so? Connect the dots for me between a standard utility company and an AI algorithm.
Well, training and running advanced large language models requires server farms running around the clock.
Mm.
And those data centers, they generate immense heat and require just an unfathomable amount of electricity.
Right, both to power the chips and to run the cooling systems.
Exactly. A standard AI query can require like 10 times the electrical power of a traditional internet search. Local utility grids are just not equipped for this kind of load.
Mm.
So energy companies literally have to consolidate. They need the scale to build next-generation utility infrastructure, secure vast land rights, and develop renewable energy sources just to feed the data centers that run the AI.
That is wild. So an AI boom forces a literal power grid merger. And it isn't just an American phenomenon either, is it? The earnings call specifically highlighted that client activity was incredibly strong in Asian markets, driven specifically by robust AI capital formation.
Yes, that was a key point.
They reported that their equities financing revenues in Asia were up 91% year over year. What exactly does equities financing mean in this specific context?
So equities financing essentially means providing the leverage, the loans and financial structuring for hedge funds, asset managers, and institutional clients who are actively trading in the stock market.
Okay.
So an increase of 91% in Asia indicates that these massive pools of capital in that region are aggressively positioning themselves around AI companies, and they are borrowing heavily from Goldman Sachs to amplify those trades.
Right, so we have this picture of a trillion-dollar M&A boom driven by the physical and technological demands of AI. But how does a bank actually capture the value of that momentum without just acting as a one-off toll booth?
Right. You want recurring revenue.
Exactly. And throughout the remarks, the management team kept leaning on this phrase, the one Goldman Sachs operating ethos and the multiplier effect.
Yeah, the underlying mechanic they are describing there is a corporate flywheel. It is the strategy of ensuring that a single relationship in one part of the bank automatically generates revenue in, 3 other parts of the bank.
See, I am naturally skeptical whenever I hear corporate executives talk about synergy and their magical flywheel. It usually just sounds like slick buzzword bingo to distract from slow growth.
Oh, completely.
Do the numbers actually prove this multiplier effect is working in reality?
Well, the skepticism is completely warranted. But the data they released actually offers pretty concrete proof. Since the start of 2025, there have been nearly 900 referrals from their investment banking division directly to their wealth management division.
Wait, 900 direct referrals? Walk me through the actual mechanics of how an investment banking deal turns into a wealth management account.
Sure. So consider the day after a major corporate event, like that SpaceX IPO. The founders and early executives go from being, paper rich to suddenly having massive liquid personal fortunes.
Right, they cash out.
Exactly.
Hmm.
And because the investment bankers were in the boardroom, serving as the trusted advisors for the IPO, they simply walked down the hall and introduced those newly wealthy executives to the bank's wealth managers.
Oh, that's brilliant.
Yeah, the firm captures the fee for taking the company public and then immediately captures the ongoing management fees for investing the executives' personal windfalls.
That makes perfect sense. Keep the capital inside the ecosystem. And it really seems to be driving historic results. Their asset and wealth management division, so AWM, delivered its 34th consecutive quarter of long-term net inflows.
34 quarters is a long streak.
Yeah, they pulled in $91 billion just in this quarter alone. Management and other fees were up 20% to a record $3.4 billion, and their total assets under supervision passed $4 trillion.
The scale is just immense. But notice that they aren't just managing the wealth of tech billionaires, right? They are increasingly taking over the portfolios of massive corporations as well.
Right, the remarks actually mentioned they were just appointed to manage the retirement plans for Verizon and Lockheed Martin. That represents $70 billion in assets just between those two companies.
It's a huge win for them.
But I don't understand why a defense contractor like Lockheed Martin wouldn't just manage their employee pension fund internally. I mean, they clearly have the resources to hire their own finance team.
Well, the markets have simply become too complex. Goldman is managing these funds through Comprehensive OCIO Solutions, which stands for Outsourced Chief Investment Officer.
Okay, so they farm out the whole job.
Exactly. Because to generate the returns required to fund a modern corporate pension, you can't just buy a simple mix of stocks and bonds anymore. You need exposure to private credit, complex derivatives, and alternative real estate assets.
Stuff that requires deep expertise.
Right. A telecom company or a defense contractor doesn't have the institutional infrastructure to trade those exotic assets globally. So they outsource the entire chief investment officer function directly to the bank.
And that perfectly sets up our next major segment because managing all that complex risk is what leads us into the debt and fixed income divisions. The earnings call spends a significant amount of time detailing a massive jump in their debt underwriting and private credit markets.
Yeah, their global banking and markets generated a record $15.5 billion in Q2. And while their equities revenues hit a record $7.4 billion, their fixed income revenues were also up 32% to $4.6 billion.
And this is where I really need you to untangle a contradiction for me. We have booming equity markets, record-breaking IPOs, and tech stocks are surging on this AI wave. Yet they reported that their debt underwriting was up 75% year over year to $1 billion.
Right.
They had their best quarter on record and ranked first in leverage lending. Plus, their alternatives platform raised a record $59 billion in Q2, with $31 billion of that flowing directly into private credit.
It's a lot of debt.
Right. If the stock market is doing so well and companies are just flush with equity, why are they borrowing so heavily?
So if we connect this to the bigger picture, you really have to look at global monetary policy. The stock market going up does not automatically mean the underlying economic environment is stable. We are currently seeing massive rate dispersion across global central banks.
Rate dispersion, meaning central banks are moving in different directions.
Exactly that. The European Central Bank might be cutting interest rates, while the U.S. Federal Reserve holds them steady, and the Bank of Japan actually raises them.
Oh, wow. So it's all over the place.
Yeah, and if you are a multinational corporation trying to fund, say, a 5-year AI infrastructure project, that kind of currency and interest rate chaos is terrifying. You can't rely solely on issuing stock.
So what do?
You turn to a bank to issue structured debt, basically bonds tailored to hedge against those specific global risks. It is kind of like buying a complex insurance policy on a cargo ship while it is actively navigating a hurricane.
Okay, so the borrowing is a hedge against global instability, not necessarily a sign of financial distress. That makes a lot of sense. But what about the other side of this? The CFO mentioned something incredibly interesting about sponsor volumes, which I understand is industry parlance for private equity activity.
Yeah, the CFO noted that sponsor volumes are currently subdued versus historical averages.
But if the overall market is white hot, why is private equity just sitting on the sidelines?
Well, private equity firms rely heavily on cheap debt to buy companies, restructure them, and then sell them for a profit. When interest rates are elevated and volatile like they are now, their traditional mathematical models break down, which basically causes them to pause their deal-making.
But wait, the bank is still hitting record revenues, even with private equity basically asleep at the wheel.
And that is the crucial takeaway. This subdued activity acts like a tightly coiled spring. Private equity firms raise capital from investors that they are legally obligated to eventually spend.
Right, they can't just sit on it forever.
Exactly. This unspent capital is known as dry powder. And right now, there's a mountain of dry powder sitting idle. When those sponsors finally adjust to the new interest rate environment and start deploying those trillions of dollars, it represents a massive wave of future revenue for the investment banks that will facilitate those deals.
That is wild. The engine is already running at record speeds, and an entire thruster hasn't even been ignited yet.
Exactly.
Let's look at how all of this revenue actually trickles down to the firm's bottom line and their operations, though. Because generating $20 billion in revenue is great, but it doesn't mean much if your expenses aren't eating it all.
Very true. And the management team was very eager to highlight their material operating leverage. They improved their efficiency ratio to 58.8%, and their compensation ratio dropped to 31%.
Meaning they're generating way more revenue, but spending a smaller percentage of it on operational costs and employee bonuses.
Right.
What about the actual strength of the bank's reserves, though?
So they reported a Common Equity Tier 1 ratio, or CET1, of 12.9%.
Is the 12.9% a strong position to be in? Because I know regulators enforce pretty strict minimums on how much capital these banks have to hold.
It is exceptionally strong. The regulatory floor they are required to maintain is 11.4%. By holding 12.9%, they have this massive buffer. They proved the resilience of this fortress balance sheet by comfortably passing the recent CCR stress test.
That's the simulated doomsday scenario the government runs, right?
Yes. The Federal Reserve artificially models a severe global recession. Massive unemployment spikes, commercial real estate crashes, plunging stock markets, and forces the banks to prove they have enough capital to survive it without a taxpayer bailout.
And since they passed it.
Passing it with a wide margin allows the bank to return excess cash to its shareholders.
Which they certainly did. They increased their dividend by 25% year over year to $5 a share. To put that in perspective for you listening, that is a 150% increase over the last 5 years.
That's massive.
They also repurchased $4 billion in common stock. They did mention looking forward to the swift finalization of Basel III to get a more risk-sensitive framework. For the listener, Basel III is an international regulatory framework, correct?
Yes, it is. Basel III dictates the specific formulas banks must use to calculate their risks and capital requirements. The bank's leadership is essentially lobbying regulators to finalize these rules in a way that provides them with more flexibility to lend and form capital, rather than relying on overly punitive blanket capital requirements.
So what does this all mean? We've spent this deep dive talking about AI infrastructure, algorithmic trading, and these massive technological shifts. But the CEO took a moment in his remarks to focus on the human factor.
He did, yeah.
In a world utterly obsessed with AI automating white-collar work to cut costs, why is a ruthless Wall Street giant so adamant about keeping its highly paid human bankers? The CEO explicitly stated that while AI changes how work gets done, it will not replace what matters most, which is their extraordinary people.
This raises an important question of the fundamental nature of high-stakes finance. We are rapidly entering a world of infinite AI-generated information. Because data generation is becoming virtually free, data itself is basically becoming a commodity.
But you can't commodity trust.
Exactly that. When a founder is deciding whether to sell their life's work to a rival corporation, or when a corporate board is deciding how to restructure a multi-billion-dollar pension fund, they are not going to ask an algorithm to make the final call.
Right.
The stakes are simply too high.
The algorithm can run 10,000 risk models in 3 seconds, but you still need the veteran banker sitting across the mahogany table, looking the CEO in the eye and saying, given everything we know, this is the right move for your legacy.
The judgment and the relationship are the actual products being sold at this level of finance. AI is viewed merely as a tool to expand the capacity of those human bankers. It allows them to analyze more data and serve more clients faster, but it absolutely does not replace the handshake. In a sea of automated noise, the premium on trusted human judgment actually goes up.
Well, this has been an absolute masterclass in looking under the hood of the global economy. Just to quickly recap the staggering reality we've unpacked today for you listening, we are looking at a world experiencing a $1 trillion M&A boom driven entirely by a corporate scale imperative.
Yep.
We are seeing an AI infrastructure ripple effect that is fundamentally reshaping how energy grids and physical data centers are built across the globe. And we are watching a multi-trillion-dollar wealth management flywheel capture the profits of all that activity by serving both the founders and the corporations involved. This isn't just a quarterly earnings update, it is the financial blueprint for the next decade of technological evolution.
Yeah, the sheer velocity and scale of the capital required to build the future they are describing is unprecedented.
Mhm.
It requires an entirely new level of global financial coordination.
And that leaves us with a final thought I want you to mull over as you go about your day. We learned that despite all these record breaking revenues driven by the AI infrastructure boom, private equity sponsor volumes are currently subdued. There is a mountain of uninvested capital just sitting on the sidelines waiting for interest rates to settle.
Just waiting.
Right. So if these are truly just the early stages of the AI build out, what happens to the global financial system when those private equity sponsors finally unleash their trillions in dry powder into an already white hot AI supercharged market? Will it build the future faster, or will that sheer volume of capital overheat the engine entirely? Keep exploring how this incoming secondary wave of capital might reshape your own industry because the water is only going to rise. We'll catch you on the next deep dive.